Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admiral Markets. My name is Klatt and I'll be the moderator here for the upcoming 40 to 45 minutes. And we want to dig into, I think, very interesting topic. Today's topic is how to trade like a hedge fund manager. So it's been a while since performances of hedge fund managers have been overwhelmingly great. Let's put it that way. So hedge funds have seen some greater capital outflows due to difficulties over the last years, and that was probably mainly driven by the zero yield policy from central banks around the globe. Correlation, in fact, becoming a big issue, in fact. And nevertheless, today we wanna dig into that topic and shine a light, at least at some of the most and well-known strategies they try to trade and, in fact, capture an advantage and generate alpha for their investors. So today, the agenda is, first of all, we want to answer the question, what is a hedge fund? After that, we'll dig right into the first strategy, long-short equity, in fact. Probably some history here where hedge funds find their origin. In fact, I just realized, but this is not right yet the topic, but once we'll open the first strategy, I probably have to turn around to my little library here and then put out a book, which is probably of interest for you in terms of hedge funds. The link, by the way, for all these people watching this video now on YouTube, you will find it in the description box to the book then. I haven't prepared it right now, but just an idea I just got. After long short equity, we will look at market neutral. To some extent, we already digged into this topic. So probably you recall a webinar here within this Trading Spotlight webinar series. We called it pair trading or pairs trading. And we traded so-called fungible goods, in fact, like Pepsi against Coke when it comes to stocks, for example, but also WTI, crude oil against Brent oil, for example. So market neutral strategies which try to aim to profit from imbalances, in fact, in markets and generate a delta neutral profit, in fact, for the investors. We look at fixed income arbitrage, and then we look at one of the probably most well-known strategies, one I in fact prefer in my trading too. We call it global macro. Even though here, if we talk about global macro, I think the first name which comes to everyone to its mind is George Soros, for example, the man who broke the Bank of England in 1992, together with Stanley Druckenmiller, for example, with their quantum hedge fund, and known as global macro players, in fact. Before we start, first of all, here, this is me. So before I dig too deep into this topic, I just tell you, please check out the link, which you find right now in the chat box here within the live webinar, respectively. Please check the description box in the YouTube webinar for an interview I did together with Admiral Markets over 1 year ago to shine a light on my person, where I come from, how I got started in the world of trading, in fact. And I just want to leave it at the point that I'm located in Berlin, in Germany. And this is of interest because here we come right to the broker behind this trading webinar spotlight, trading spotlight webinar series that way around. Admiral Markets, a broker which is in the industry now for close to 20 years. In fact, I think next year it's the birthday. A broker which is it's a global player, we have to say that, with 20 and more offices around the globe, one in Berlin in Germany, and a leader in the Forex and CFD financial industry, with over 8,000 financial instruments being offered. But not only that, so you can also, via the so-called Admiral Invest solution, trade, for example, physical stocks So a true multi-asset broker. And just to close this here, the final words is, in Germany we refer to Admiral as the so-called DAX expert, due to the very, very competitive offering when it comes to DAX trading. But it's not limited to DAX trading. In fact, last week, you remember, we also shed a light here on brokers, how they make money, respectively, the spreads you have to take a deeper look at once you're an active trader, especially due to the costs which are connected with the spread. And we found out that Admiral is also in the FX environment, for example, one of the brokers with the most competitive offering, I'd say, due to very, very tight spreads, which are offered all day long, in fact. So in FX trading, we're talking about a 24/5 market. So that's it around the introduction. And now we want to dig deep into the topic, what is a hedge fund, and start here with the first point. So hedge funds are alternative investments. Well, they are usually referred to as alternative investments, which is one of the reasons why it's not granting access to every, especially retail client. In addition to that, it's not only that here as alternative investment that the complexity of the used strategies needs you to be a well-informed and qualified investor. But in addition to that, it's also a question of money, in fact, and how much net worth you have to get access to these hedge funds. But in case of hedge funds, we're talking about alternative investments using different strategies, trying to capitalize on so-called inefficiencies in rising and also in falling markets. So this is where the term hedge comes from. So while, for example, a long-only portfolio only profits from rising markets, for example, an ETF, hedge funds have the opportunity to also short the market and profit from falling markets. It's a very simple way to put it. And some might probably wonder why hedge funds lost tremendous amounts of money during the latest market turmoil in March, April, so-called, let's call it the COVID-19 lockdown. But this is also true for example, the elevated volatility at the end of 2018, for example. Some might probably wonder where this bearish, in this case, outperformance came from if they are hedged, in fact. And this is one of the reasons why many investors wondered why hedge funds keep on charging 220, we call this, so 2% management fee and 20% performance fee for being, and when looking at the performance, it seems as if they are just, for example, building long positions in the S&P 500, for example. So some stock pickers probably around them, but all in all, it seems as if you're paying a hefty fee for an investment which you could easily copy yourself by, for example, buying an ETF yourself. Spider ETF, whatever. So that's one of the reasons why hedge funds came under, why critics started to question why hedge funds are still in the marketplace. But one main reason might be why hedge funds, especially for high net worth clients, are interesting is that they are less regulated than mutual funds, for example, which means not just that they can expand their universe of tradable markets and strategies using leverage and so on, but in addition to that, we also talk about sometimes hedge funds being located in so-called tax havens. So it can be also very interesting for high net worth clients, which is the next aspect. I already mentioned it. It can also be interesting from a tax perspective. So I'm not talking about tax evasion. I'm talking about optimized an optimized portfolio from a tax perspective. Let's put it that way. And again, as I already mentioned at the beginning, to invest in a hedge fund, clients usually have to be so-called HNWs, which is high net worth clients. So it's the short of or for high net worth clients. And what's very interesting about hedge funds, this is also something which needs to be considered once you invest with a hedge fund, and why you need to be well educated, well informed, and be aware of the risks, is that hedge funds tend to be illiquid, which means nothing more that investors need to keep their money invested for longer periods of time, in fact, and withdrawals are only possible at certain periods of time, which is difficult. Let's put it that way. Just imagine you're a high net worth client and you put some money aside and you invested with a hedge fund, and then market turmoil, respectively the COVID lockdown, made it necessary for you to get your hands on your money, and you tried to withdraw money from the hedge fund, which was not possible due to the market turbulences, which can in fact be a big issue, in fact, and perfectly underlines why it's so important to know what you're investing here once you plan to invest with a hedge fund, if you qualify for that. And at the end, let's have a look here at some of the most known hedge funds so far to date. So Bridgewater Associates, for example, Ray Dalio, probably you heard about him. He's the founder of Bridgewater, one of the biggest hedge funds, in fact, in the world. Ray Dalio is also a guy who wrote a book. It's called Principles. I highly recommend this. It's a really great read, in fact. Then we have also Renaissance Technologies. It's short, it's Rentech, in fact. The founder is Jim Simons. He's a former NSA code breaker, a mathematician, and yeah. Well, then he went out and in fact solved the market. And there's a book which came out, I think, at the end of last year, if I'm not mistaken, which is called The Man Who Solved the Market, if I'm not mistaken. And it's from, what's the name of this guy? I have a picture in my mind, but I forgot the name. Yeah, whatever. So it's Jim Simons and Rentech. It's probably one of the, if not the most successful hedge fund of all times, with a accumulated return of something like way over 30%. Already after commissions and performance fees being deducted, in fact. Medallion Fund, for example, in this context, is something you probably want to Google and check out yourself, and highly profitable. In fact, very quantitative. We have also AQR Capital Management. Cliff Asness, probably I've heard about him. He's also quite active on Twitter. You can follow him then there. But also Citadel, for example. Ken Griffin. Citadel is very well known for HFT strategies, in fact. Was also massively underwater, in fact, in 2008, around the great financial crisis. 1 second, please. I will just check out whether I find the book. So this book here, let me just show it here. More Money Than God. I highly recommend reading this. This is, in fact, a story behind hedge funds, how they got started. That was at the age of the 1940s, in fact. And this is where the next slide comes from. Long short equity. This is where they in fact started, and it's here. The first bullet point. The first hedge fund used a long short equity strategy and was launched by Alfred W. Jones in 1949. And the story behind this is written down in this book, More Money Than God. Again, I highly recommend reading this. If you check out the video now on YouTube, check out the description box for the link. Let me just see whether I'm quick enough here to find the link, and I will share it with you in the chat box. More Money Than God. There we have it. Yeah. So let me just post the link here. There we go. Yeah, so let's come back here to today's topic, and here at the long short equity approach, in fact. So data shows that still many hedge funds use long short equity strategies. This is to some extent exactly what I just described, and where you can then spot the critics, especially, and that they have a solid point, because in a bullish market environment, as we've seen now since 2010, in fact, due to the massive liquidity injection from central banks, it just doesn't make sense to try to stock pick, but you just need to buy a basket of stocks which is running in your respective direction, long only, in fact, outweight long positions, and you don't really need to hedge the portfolio. In fact, if you hedge the portfolio, you would just lose, in fact, a performance, and that's one of the reasons why hedge funds have seen some broader capital outflows, in fact. Yeah, so in this context, the concept behind this, it's quite simple behind this strategy, long short equity approach. So positions in equities are taken on the long but also on the short side based on so-called relative strength. To put this in a better context, so winnings are used, in fact, as a so-called collateral to finance losing positions, with the combined portfolio creating more opportunities for idiosyncratic, so in this case, for example, stock-specific gains, with reducing market risk due to profit from falling markets and short positions, offsetting losses in long positions. And I think this is probably a little too, how can I say? I mean, too pathologic, probably, so it's difficult to understand. I think that the easiest way, in fact, to understand this is to just remember our webinar on pairs trading, and we here introduced the strategy trading two fungible assets. In fact, it's very similar. So it's not just long short only, long short equity in this case, this strategy, but it's also the market neutral strategy I referred to at the beginning, and which we'll shine a light on then in the next slide. But what we here do is, in fact, we search for two fungible assets, and then we buy the one which is relatively strong, and we short the one which is relatively weak in this case. So which means nothing more than we expect the relative strong stock to outperform in a bullish environment, while we expect in a bearish environment, once the market declines, once there is some kind of external shock and markets are under pressure, you expect the relative weak stock you have in your portfolio to underperform on the bear side, in fact, due to whatever, some skeptics around, or skepticism around the management or balance sheet is let's call it cleaner at the relative strong company than at the relatively weak company, whatever might be the reason. So you expect, in fact, to offset losses in a dropping market by being relatively weak stocks short in a balanced long short portfolio, while you expect the relatively strong equities to outperform in a bullish market environment. And this is where the outperformance, in fact, comes from. And yeah, so that's at around long short equity. So as you can already see, this is no rocket science, in fact. So I mean, certainly, I mean, we oversimplify things here. So but the basic idea behind running a long short portfolio, for example, is nothing which requires much skill, in fact, and everyone can build his or her own hedge fund at home with opening an account, for example, with Admiral Markets, in case, and building a portfolio. And this is even more true since in case of Admiral, for example, you have a true multi-asset broker, which means you can easily build a portfolio, for example, whatever strategy you might be after. Let's put it simply. Just imagine the following: you want to save some money and invest it in dividend stocks, for example. We also had several webinars on this topic in the past, and the idea behind this is to create an income stream you wanna have in once you're older, once you retire. And now the thing is, still markets move, and you come to the conclusion, since you still follow the markets even after your retirement, you follow the developments there, that you come to the conclusion markets might be overbought, for example. Currently, right now, shortly before I started this webinar, for example, and after this massive run higher, after this crash in April, for example, March, April, I just came across a very, very interesting aspect, since the so-called investor sentiment in the US, for example, it's the AAII, it's an investor survey they usually run. it's currently the bulls here within the survey are at their highest level since January 2018. February 2018, there was a sharp drop due to the explosion in volatility back then, if you remember. We had the largest weekly jump in bulls since July 2010, in fact. We've seen capital inflows, so into also passive managed funds, for example, of 32 billion, in fact, the second largest capital inflows on record. Why do I say that? Well, because this is something which points to a potential sentiment extreme. So now imagine the following. You have such a long portfolio, which pays you a good dividend, and you have your income stream generated by these dividends. Still, you'd like to see the value of your portfolio not decrease that much, especially not if markets are dropping massively. What do? Well, you open a trading account with Admiral. So you have one Admiral Invest account where you have your ETF or your physical stock exposure. You open a trading account, and there you have the chance to easily short, for example, an ETF or the dividend-paying stock, for example, via CFD. So once here, you are delta neutral, we call this. So you do not profit from rising markets anymore, but you also do not lose any money once market drops, in fact. And so you are delta neutral. But still you have the dividend being paid. So which is to some extent a long short equity portfolio. You hedge your bullish performance or your bullish exposure, not performance, but exposure, and try to avoid sharp drops, in fact. And once you think that the market is about to bottom, you not just reduce your short exposure in your position, but you close out the short position, and you probably acquire at a cheaper price more stocks, in fact, which will pay you a dividend in the future, and where you potentially will profit then from a rising stock price in the future if the market continues to rise. So if you want, you're running your own hedge fund in this context, in fact. So that's just around the topic long, short equity and how to trade that. Now, the next slide, we'll dig into the concept of market neutral, in fact. And this is something, we to some extent already introduced, in fact. So when looking at long-short equity, one will usually see a natural tendency that these hedge funds typically have this net long market exposure. So being not fully hedged, that was something I talked about now several times in the last minutes, because once you look at the performance from hedge funds, many will wonder, how can someone refer to himself as a hedge? So to be hedged a fund, once the market drops, he will see a bearish outperformance, and then he will lose probably not 30% as the S&P did in March, but he will still lose something like 20%. Still, it points to some kind of hedge, but still, some might argue that this is not what they hoped to get once they invested with the hedge fund. And in this context, then these market neutral HFs, by the way, is hedge funds. I shortened it up here in this presentation. So market neutral hedge funds, which target this aspect, in fact, and are fully hedged. So they don't have any net market exposure. So they're what I just referred to a few minutes earlier as delta neutral, in fact. And so performance here from managers is here generated via pure stock selection, or by running, for example, quant models, where you try to spot undervalued assets, respectively overvalued assets, stocks, but also other goods, like, for example, as we put it, you see a Brent oil, for example, overvalued compared to WTI crude oil, and that's why you short Brent while you expect WTI to rise over the short term, and then you're long WTI, and this way you hedge out your exposure. In this context here, we're talking about stock selection, which all in all are targets on the same aspect, in fact. So in the current environment, for example, once we talk about stock selection, for example, if I'd had to choose now for my portfolio which stocks to outweigh, for example, I wouldn't go extraordinarily and massively long in growth title, like Google, like Amazon, like Microsoft, like Apple. And why? Well, we have seen that already last Monday. You probably have seen that once these vaccine headlines hit the newswire that Pfizer and BioNTech had found a potential vaccine for COVID-19, stocks exploded on the upside, but it wasn't only stocks which exploded on the upside, but the S&P performed extraordinarily bullish, while the Nasdaq found itself in negative territory, and probably it bottomed out now. But you can, when looking at the chart, see that growth title saw a massive underperformance compared to value title. In fact, so growth massively underperformed value over the last days, at least, and that was something we could have seen. And once you check out the performance from value stocks compared to growth stocks, for example, there was a massive outperformance from growth. And the question now is, if there is such a, let's call it reflation, and if there's really a vaccine, and if there's really a journey back to normal, let's call it. So that's sad, which means that people will get the vaccine, and after that we can start to live our lives as we lived it around 1 year ago, with going wherever we want, travel wherever we want, buy wherever we want, not wearing any masks anymore and everything. So just going back to normal. I doubt that, by the way. So that's just one thing. But if you now come to this conclusion, well, you have seen that growth stocks massively outperformed due to the outlook of cheap liquidity and massive central bank interventions. And once you now see a reflation here, or let's call it sector rotation, we can call this, from growth to value, you see an underperformance from growth titles compared to value. If you now still are skeptical, so you see some kind of more restrictive monetary policy path, and thus not that much monetary policy support from central banks, but still expect, for example, the Fed to continue to expand their balance sheet. This is something which gives an overall, even though very roughly, but a subdued outlook for growth title, for example, but an overall bullish outlook for gold, for example, and thus for mining stocks, which means nothing more than, in such a market neutral approach, for example, I'd now see via my stock selection and my overall idea or view I have on the market, I consider mining stocks here, also due to their very solid balance sheets they have. I see mining stocks to potentially outperform over the next years, while I see growth titles underperform. And this is how you can imagine market neutral strategies here, in fact, to perform, which means nothing more that in this context, for example, I'd buy, in this case, gold mining stocks or mining stocks in general, and short or at least underweight tech title in my overall portfolio. And so let's come back to market neutral, respectively, long short equity in market neutral. They have been criticized. I mentioned that already quite a while now, or several times that way, over the last years, with not really delivering alpha, in fact. And alpha means that they deliver a performance which is going back, I mean, I don't want to get too academic here, but going back to pure stock selection, where it's a skill. So once you invest, for example, in a growth stock, you're paid, and the outperformance you see compared to the overall market, once there's a favorable market environment, is something that's one of the reasons why they refer to growth stocks also to high beta stocks. So you're getting paid for taking an enormous risk that the overall business model might fail. Let's, for example, look in this context at electric vehicle producers like Tesla or NIO, for example, just to name two. And these are high beta stocks, which means once you invest there and see an outperformance, it's not because of luck, but it's because of you taking an enormous risk. In case of hedge funds, this is usually an industry, and the hedge fund managers especially, they are considered to be kind of market wizards, let's call them. And they are expected to find stocks which are outperforming the market by not adding massive risk to the overall portfolio exposure, in fact. And this is what then we refer to as alpha in this case. And this is usually what then would justify such charging a management a performance fee of 220, in fact. But if it's not the case, and they are in fact just generating performance due to taking on enormous risks, for example, and being long growth title or something like that, that has nothing to do with alpha, but it's more like they are generating performance by being heavily overvalued in high beta stocks, in fact. And so let's come back to the underperformance aspect. So the underperformance, in fact, does not necessarily come as a big surprise with stocks going up, down in unison, in fact, but also with ultra low yield market environment around the globe, eliminating earnings from stock loan rebates, for example. What do I mean by that is that and for example, you can loan out stocks you have in your portfolio, generating an income stream as a hedge fund, which is then, I haven't yet the numbers available, but something like 1 to 2%, and something which you usually can only do once you have a certain, what's the word for this? German is height. So you have to have a certain volume, or have a certain number of assets under management here to be capable of profiting from such stock loan rebates, for example. And so that said, this is also a strategy which runs under market neutral. Having that said, yeah, perfectly illustrates, in fact, where the performance comes from. All in all, it comes all down to try to spot an underperforming stock being long once it's underperforming, not undervalued, once you try to short the overvalued company. And it all comes down to long short, respectively, market neutral strategies, which try to profit, for example, from, once you have the great position, loaning out stocks, for example, another strategy. And all this comes, in fact, down to buy low, sell high. They are only selling it in a very, very, how can I say that, sophisticated way, charging you 220 for this. Well, again, if there's a hedge fund, let's say, which is really worth its money, for example, when looking at Rentec, I think this is also a perfect example how well they performed over now nearly 40 years and really outperforming the market. This is something, yeah, which is kind of, let's call it. I'm missing the word. So German word is Ausnahme. This is like, yeah, whatever. So let's come to the next strategy here. In fact, I just have to check the clock. So we are running out of time a little. Let's have a look at fixed income arbitrage. Next strategy, which is obviously looking at yields, respectively bonds, in fact. So fixed income arbitrage, and here hedge funds usually work with so-called high leverage. This is very interesting because we've seen that in the market. I will give you a better idea in a few minutes. So fixed income arbitrage usually works with high leverage to eke out returns from risk-free government bonds. In fact, HFTs, HF managers, so higher hedge fund managers here make leverage bets on how the shape of the yield curve will change. And just give you an example here. Oh, I'm sorry. This was now here, this next bullet point. So just to give you an example, if the hedge fund manager, for example, expects long rates to rise relative to short rates, so in fact, betting on the yield curve to steepen, expecting the economy to rise, in fact, in the midterm, or to grow the economy of the underlying bonds here to grow, then he goes short the bonds with longer maturity, since there's a negative correlation. So if yields rise at the long end of the yield curve, you're shorting the bonds because rising yields correspond with dropping bonds, while dropping bonds, or bond yields in this case, converge with rising bonds. And yeah, so you're going short the bonds with longer maturity, or bond futures in this case, and then you buy bonds with shorter maturity. And this is a very simple strategy, in fact. And let's have a look here what just happened, what I was referring to. So these hedge funds, in fact, came under scrutiny last year, 2019, in September, when volatility in the so-called repo market increased massively, and also were one main source of the massive volatility in bond markets during the Corona lockdown at the beginning of this year, resulting in a sharp rise in US yields, which spilled over to the corporate bond market. I haven't prepared now a chart for this, but if you check out the price action from March, April, you will see that there was short-term a massive spike in 10-year US yields on the upside after it really collapsed and went then below 1%. And one reason was that what they currently doing is, if you're trading in the future, in the bond future, in fact, a T-note future, for example, or T-bond, depends, 30 years, 10 years is 10 years T-note, 30 years is T-bond. What you usually do is you try to profit from a short differential between the cash market and the future market. Usually what you see is that they are long the cash position or the cash market, and they short the T-note, in this case, so the future, in fact, and they bet on a converging differential till the end of the future contract, once the contract expires. And now the thing is that the difference is so small that they have to build massive positions, in fact, or use massive leverage. That's probably a better way to put it, to profit from this small difference. Now, the thing was that once there was this Corona lockdown development, that this so-called in German, we call this Basis. This is the difference. So the difference between the cash and the T-note future, in fact, or the cash and the future market, it increased that much that margin calls not just occurred, which resulted then in these hedge funds to have to shut down their position. But in addition to that, there was something really interesting. The differential went so wide in the bond market, or between the cash and the future market in this case, it went so wide that, for example, companies, financial companies, which are usually not working in the fixed income arbitrage sector and usually just invest in corporate bonds, for example, they said, you know what, we can still profit from this massive and wide differential here by using no leverage at all. The only thing we have to do is we need cash. And where do we get cash from in an environment in which currently no one is lending out any money and wants to invest with a financial service provider or investment fund or whatever company? Well, we have to sell corporate bonds. So it's very roughly speaking, but they sold out their corporate bond exposure, which resulted in massive spikes in the corporate environment to just try to profit then from the massive differential between the future and the cash market in government bonds, which they could profit from even though they are not using any leverage because the differential was that wide. So you can see here, once you look behind the scenes and understand how these fixed income arbitrage trades work, they usually work wonderful in an environment where there is no kind of, let's call it, elevated volatility. But once volatility picks up and once these spreads widen to an extent which becomes, how can we call this? Not natural anymore, or too wide, it can cause a spillover effects on, for example, the corporate world, and then result in massive spikes in yields and elevated volatility here. So that, just to give you an idea on how this works and where the fixed income arbitrage strategy from hedge funds here comes into play, then when it comes to the developments we've seen at the beginning of the year in March and April, respectively, already in September 2019, where the, let's call it, I think it was Jay Powell who called this technical issues with the drying out liquidity in the repo market, which made it necessary from the Fed here to massively intervene and ramp up their balance sheet again, just to make sure that there's not this potential credit crunch in the repo market. So, and at the end, let's have a look now at my personal favorite, in fact, global macro and this strategy. So, it's an approach where hedge funds analyze macroeconomic trends, in fact, and try to figure out how these will affect interest rates, for example, currencies, commodities, equities around the world, and then take a long or short position in whichever asset class is most sensitive to their views. What's very interesting here is, as I already mentioned, it's a very famous example of Soros betting against the pound sterling in 1992, for example. But what's very interesting, by the way, I just realized that's the next bullet point here, very interesting side note. So first of all, these hedge funds, these strategies usually need high liquid instruments, and can be found then, or once you trade these approaches, you find this in the future markets or currency forwards, for example. But what's even more interesting is the global macro hedge funds are not necessarily hedged per definition, in fact. So they make, in fact, quite big directional bets. So, for example, one approach right now probably might be that many central banks are about to expand their QE, respectively, balloon their balance sheets even further. For example, the Fed, for example, the ECB. And what hedge funds now, the conclusion they come to is, in fact, that they say, well, this is an environment of long years to come of zero yield policy. In fact, even negative rates we have to expect, which is a very favorable environment for gold in this case, which means we take a big bet, for example, on being long gold or long mining stocks, very simply put, in fact. But this is what they usually do. What I referred to at the beginning, for example, when we was still were on the slide for market neutral, what you would now probably do is to make it not that aggressive. In fact, you could probably short, for example, growth stocks, or, for example, short the S&P 500. If you expect, for example, the S&P 500 to underperform in the years to come, while you expect mining stocks to outperform, in fact, or in fact physical positions, even though it might be very difficult for a hedge fund here to position himself, for his clients, for his investors, in physical gold positions. In fact, what he would do is most likely invest in mining stocks, for example, or in junior miners, silver mining, or whatever. So this is usually the way to go then for these hedge funds. But this is a combination, in fact, between global macro and delta neutral, or to some extent also long equity short, in fact. And as a result, returns of these global macro hedge funds are not very consistent, but instead very volatile compared to other hedge fund strategies. And as seen here, for example, with Soros, I think he lost quite a bit, especially then in the years after his big bet against pound sterling in the Bank of England in 1992. I think at the end of the 90s, he lost serious money in the Asian crisis, in fact, and the Thai baht, I think, going massively down. I'm not really sure, but I think he was on the wrong side of this trade here, even though I'm not sure. But this is usually what you then read in the newspaper. So due to these big directional bets, usually you have big gains, but on the other hand, you certainly also have big losses once such a directional bet goes the wrong side, and these market wizards are caught on the wrong foot, in fact. So let's sum this up. So first of all, hedge funds are alternative investments using different strategies, trying to capitalize on inefficiencies in rising and falling markets. They are usually less regulated than mutual funds, for example, expanding their universe of tradable markets and strategies using leverage, especially. And to invest in a hedge fund, clients usually have to be high net worth clients. Some of the most commonly used HF strategies, hedge fund strategies, are long short equity, market neutral, fixed income arbitrage, and global macro. And as I said at the beginning, everyone in today's world, everyone can in fact be his own hedge fund. and run a portfolio of different strategies within his trading account. And as I already pointed out, in case of a broker like Admiral Markets, having a broker here, a true multi-asset broker, you have an opportunity to hedge your exposure, in fact. So if you're invested in physical stocks, for example, trying to profit from dividend payments, for example, to generate an income stream, you still can hedge your exposure by shorting the respective stocks or the basket of stocks, the ETF, by using CFDs, for example, as a tool here to save the value of your overall investment, in fact, and the probably compounded growth in terms of capital gains you probably have already seen beside a dividend, which is then paid out over time. So that's it around today's topic. Don't forget to join us next time. At the same time on Monday, Paul will be here and talk to you on currency correlation and how to use it in your trading. He will talk about, or answer the question, in fact, what are currency correlations? Why are different currencies correlated? How to use currency correlation in your trading, and how to lead onto intermarket analysis. Oh, no, I'm sorry. How does that lead? How does that lead onto intermarket analysis? So same time Monday, 2 p.m. London, 16th of November. Check your inbox if you're here right now for the live event. Check your inbox for the webinar link to take part, to participate here. If you watch this on YouTube, if you just enjoyed what you saw, please leave a thumb up here. And head over to admiralmarkets.com to the Trading Spotlight webinar tab to register here for the next webinar then with Paul. And admiralmarkets.com. Check out the website. Here are the contact details if you want to check out the service from Admiral Markets. Again, outstanding, just to let you know. So you definitely find someone in your respective language, with 20 offices and more around the globe. And highly regulated. That's the last slide. That's why we have to look here at the risk disclaimer. That's it from my end. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. See you. Bye-bye.